thank you for joining us here on the Retirement Income Source, where it's always going to be about income the old-fashioned way. Yeah, income has been around a long time. That's why we call it old-fashioned. Not like the advice that's been given in the last 40 years. Just because times have changed doesn't mean that the old-fashioned way doesn't work. Believe it or not, and what I have seen, the results I have seen, meeting with clients, the stress-free income retirement plan makes more sense to people today, more so than ever, especially whenever they, make that change, make that transition. I'm Tim Sparks. Our show is sponsored by Sparks Financial Group right here in the heart of the Bluegrass, Lexington, Kentucky, serving northern, central, and Louisville, Kentucky markets. Our firm specializes in investing for income. We decided years ago, us and a group of about 40 advisors, that we want to bring in top analysts that invest in real stocks and analysts that invest in real bonds and bond-like instruments. Why is that? I want somebody superb at what they do. In other words, that's all they specialize in. Many of you know, if you hire any kind of specialist in any place today, matter of fact, that's who you're going to hire if you're wanting something specifically done. We are living in a time where specialists are more needed so than ever. Investing for income does require specialists. Every financial advisor can call themselves an income guy, but really, are they getting you real income? It doesn't matter if you were, you were put in a position where maybe they were, using some kind of software or Monte Carlo analysis and all these things and trying to come up with different ways to skin the cat, so to speak, and to get you income. Because at the end of the day, if you're selling principal, which the majority of the time of all analysis we do on clients' portfolios today, then you're really not creating income. You're paying yourself back from the money it took you 30 to 40 years to save, and now you're giving it up. And believe it or not, just like I have in my introduction in my book, most people will spend less time spending their money because they don't understand the difference between distribution of income and accumulation of income. In their distribution years, when they need income, they'll go through it less than it took to get to the point of retirement. That's not retirement at all. The whole point of actually keeping your principal preserved is so that way you can do twofold. You can have things for healthcare expenses, rising healthcare expenses, I should say, in the future. Most of you, if you're 60, 65, or 70 years old and you're maybe in retirement or contemplating about being in retirement, then that long length of time, you're going to be whittling down your principal. And if you whittle down your principal too much, you get to the point where you don't have any kind of inflation hedge or whatsoever. So now you're in more of a survival mode. Keep in mind, most retirement plans will work the first 10 years. I don't care where you put your money, unless it's so risky that you shouldn't be there. But most people don't do that. Most of us are betting that the markets are going to go up in the future when you have no way of knowing, and neither does a financial advisor, and that includes myself. That's the reason why we like to invest for income, because income is paid to you regardless of the volatility of the markets. The markets are the markets. We can't control them. What we can do is invest in a way so that way if the markets are going to go up, I'm in position to go up value-wise. That's the growth part of the total return equals I plus G. But at the same time, my income does not change. And of course, today's show is based on income doesn't change. It doesn't matter if you got $1 million, you got $5 million, or you got $10 million or $20 million, or if you got 300,000 or 700,000. At the end of the day, how much of a paycheck will that money generate you? And what I'm talking about, old-fashioned income. you really, really want to take a look at what that means. Why? Because first of all, you're going to get more mileage out of your money. You're going to stretch your dollars out further because your portfolio is generating income that is superior than the options that are available to people today. Most people use options like mutual funds that they were used to and accumulated assets whenever they were putting money away, socking away in their 401ks or SEP IRAs, simple IRAs, 403bs, TSPs, whatever. It's all plans. We set aside money so that way we can accumulate assets. Well, what instruments do we use? We use mutual funds, and the mutual funds actually helped you get up that hill, like using an analogy, climbing Mount Everest. But now you're coming down the hill. This is, this is the next 20, 30, or maybe 40 years of your final part of your life, and you want it to end well just as much as if you've enjoyed accumulating assets leading up to the point of and Pike's Peak of retirement. But see, think about it for a moment. And most of you don't even know you're actually selling about 70% of your income payment that's paid you monthly. 70% is the numbers I've actually set down and assessed, is really just nothing made up of shares. What you're doing is you're decimating slowly but surely. I can use, at the end of the day, it is what it is. It's very tragic. It's very cancerous to do this, but most people are doing it because the amount of income they're generating from those particular funds is not enough. So they have to sell shares to come up with the difference. And you're going to do that for the rest of your retirement spending years. No wonder people are worried about running out of money before they run out of breath. You ought to really take a look and see what the difference between investing for income the old-fashioned way, which is not taking away the potential of earning growth. Depends on, of course, obviously how you invest your money, but here's what I've also learned. Most people have 60% of their money in stocks in the first place, and I'm talking about mutual funds or exchange-traded funds, and the other 40% is made up of bonds and cash. Well, at the end of the day, people, really and truly, you've only got 60% of your money. It's going to go up in value in the first place. The other 40% is not appreciating assets. Those are non-appreciating assets. They're just there to keep you from losing as much when the markets go down. Well, when the markets go up, if they go up 30% and you've only got 60% of your money in the market, that means you only earn 18%. 18% only own 60% of your money. Why? Because the other did not see the same increase, no matter how you do the math. Why? Because appreciable assets are stocks and real estate primarily. But if you want to know what tools to use, especially whenever it comes to retirement, in other words, give yourself a pay raise, I want to introduce you to a great income report, Introduction to the University of Income Generating Financial Strategies. These tools will be the tools that you should use, get income the old-fashioned way, like I referred to earlier, and that income doesn't change, doesn't matter if their markets are volatile or not. The markets go down, the income doesn't change. And this commission report can be yours if you call 888-930-1080. Again, 888-930-1080. We'll mail this to your email at whichever you prefer. Again, that phone number is 888-930-1080. This is the Retirement Income Source. This is Tim Sparks, and we're talking today about income doesn't change. When markets are down, like the last few weeks, if they go down more, if we go into a recession or a correction, income investing works better in any environment because you own income-based instruments in the first place. If you take the formula, total return equals I plus G is a formula that you should learn. And, we're in an information society today, and we got too much information. Sometimes it's too complex, and a lot of times we don't know how to break it down. Well, this is the most simplest thing you need to learn. Total return equals income plus growth, or interest and dividends, which is income, the bird in the hand, and the growth is the two in the bush, the icing on the cake. Well, sometimes you don't always get the icing on the cake, but the income doesn't change. The problem is most people are accepting in retirement a lesser income. It's like considering a part-time job when you first start out work part-time income is not equivalent to full-time income. But most people, believe it or not, when they go into retirement, their income instruments that they're generating, I'm talking about the income that they're generating right now in their mutual funds, they are getting income, is equivalent to a part-time job. And I don't know about you, if I thought I can get more, why not incentivize yourself to do so? And you can do it by just hiring your portfolio. At the end of the day, your portfolio is the one that has to go to work anyway. So at the end of the day, income, if it doesn't change, what do I mean by that? Well, see, income, if you had mutual funds right now, and you had $1 million invested in those mutual funds, it's made up of shares. I'm just breaking down that statement that you see. You're probably one of those that a lot of this probably you don't know or maybe understand, and I'm going to question your intelligence. It's got nothing to do with that. Thank goodness you have money and you knew you accumulated wealth for the purpose of retirement. But the thing is, though, you want to be intentional when you're in retirement if you want that money to last. You have to stay control of the steering wheel and not get in the back seat of the cab and let somebody drive you around called your financial advisor. I don't know how many times people have came in that said they regret it that they didn't make a change sooner. Why? Because they would have more money. And once they understand the income and you're going to give yourself a pay raise, it makes perfect sense. So if you got $1 million in mutual funds and you got 60% of your money, this is what the formula today, 60% of your money in stock-based mutual funds, and you're entering retirement, 40% of that is in bonds and cash, then you're getting about $20,000 a year on that $1 million. And that's the norm. Maybe $22,000. That's really pushing the envelope. Well, if you hire a financial advisor, if they charge you 1%, which is kind of the average for $1 million portfolio, that's $10,000. So you got to subtract that from the $20,000. So that means you're only going to get $10,000 in interest and dividends from that portfolio. And when the markets go up, 60% of it, that's the G side, is going to go up in value. So your statement's going to go up in value because of that. Well, the dividends come along for the ride. They're paid to you separately. They're paid to you like rent is to a landlord. It's the same concept. There's no difference between those two. That's the reason why I say income does not change. And if you want to know more about income first methods, then I got a book I like to get in your hand. I talk about this in my book, The Retirement Income Shift, How to Get the Most Mileage Out of Your Money. The book is written by me, Tim Sparks, and it's Amazon bestseller for 3 months in a row, starting October of last year when it was introduced. And it's number 1 in 6 categories of personal finance. And this book is geared toward interest and dividends and understanding the need of that in retirement advice today, but so many advisors still neglect to use. I got a free copy for the first 5 callers of today's Retirement Income Show by calling 888-930-1080. Again, that's 888-930-1080. We'll mail this to you if you call 888-930-1080. And again, free, no obligation book. You're tuned in to the Retirement Income Source. This is Tim Sparks. I'll be right back. Welcome to the Retirement Income Source with this Tim Sparks, your host. Our show is sponsored by Sparks Financial Group right here in the heart of the Bluegrass, Lexington, Kentucky, serving Central Kentucky, Louisville, and Northern Kentucky. Today we're talking about income does not change. Well, think about it for a moment. You have 2 options. Do you want, let's say you need income. You have 2 options. There's no 3, there's no 4 or 5. You may be led to believe that, but there's really only 2 options that are out there today when it comes to investing for income. And I like using the farmer analogy. It's probably my all-time favorite. I learned this from another advisor years ago. And I've got a 300-acre farm, okay? And I'm using total return equals I plus G. The G, the growth side, is the farm itself and what the value of it is today. So that 300-acre farm is worth $1 million. So I put that underneath the G. And underneath the G, in parentheses, I put 300 acres. Okay, if I take 1 million, divide it by 300 acres, that tells me price per acre. Okay, well, the amount of income that I get from it from raising crops is $20,000. Very similar to the mutual fund analogy I was talking about earlier. It's the same structure. This is the problem. I'm trying to describe it to you. Here you are. You're taking out 20,000. The cost of the farmhand is 10,000. And now you're going to pay more for that. But I'm trying to give you what it looks like from a mutual fund perspective, which is what most people's portfolios are designed to do today, to create income. So you get 10,000 a year from real income. The problem is the farmer says there's no way, and retiree says there's no way I can live on 10,000 a year. Sure, because you got $1 million. I mean, you didn't retire and save $1 million to just take out 10,000 a year. But if you spend any more than $10,000, guess what you have to do? You have to go to the G column and remove some of those acreage, the 300 acres that you started out with in retirement, and start reducing those acreage, and you're doing it every year. So the first year, you may sell 3 or 4 acres. So far, so good. You got 296 acres left. But the problem is every time you sell an acre, you're also reducing the $20,000 or $10,000 in net income to you because you also hired an advisor to do the work for you. So you're reducing the income slowly but surely too. So what's happened is it's forcing you to take more and more out of your principal every year, slowly but surely. The process doesn't really go noticed for a few years. And a lot of that is because, for the next 3 years, if the markets go up, it's not going to go unnoticed a lot. You're still selling shares, you're just selling less shares. If using the farmer analogy, you're just selling less acres. But either way, and I know that doesn't make sense. It makes more sense to just keep the farm, keep the 300 acres, but instead of getting 20,000 netting 10,000 in income from the crops, why not get 50,000 or maybe 55,000 in interest and dividends or crops from the farm? It's the same analogy, it's the same structure, and just quit selling the farm altogether. To me, it makes more sense. Well, believe it or not, the first analogy is exactly what people are doing. They're reducing and eroding their principles slowly but surely. If they just created income by using different instruments, not using mutual funds or exchange traded funds, which got you to retirement, now put on the different set of shoes, which means, you've got to have income-based instruments that are going to give you, first of all, a pay raise, and a pay raise that gives you also permission to spend. Now you can take out 50 to 55,000 a year, and you don't have to sell any acres whatsoever. I don't know about you, I like that a bit better. And that's exactly what we do for our clients each and every month, and they don't have to touch their principal. Let's just say that you had to touch your principal. Well, right now, you already are. There's no way around it. There's not one person we have analyzed that if they took out 5% of their portfolio, they're not spending principal out of their portfolio. They can slice and dice it and try to convince themselves otherwise. It doesn't really matter. I can break it down for them with the total return equals I plus G. That's the formula. Like I said, you want to commit it not just to memory, but understand how it works. And that will make a difference of how much principal you will be selling on a monthly basis to create an income paycheck. It's been done, unfortunately, 99% of the time of most portfolios that I see. The only time I don't see it is if somebody's not taking income at all from their portfolio, or they're not taking but maybe 1% or less. That's whenever I see nobody spending any principal. Most people are not doing that. And not only that, let's just say you're one of those that don't really need your money. And at least for now, you don't need your money. Well, you have an IRA. Well, if you have an IRA, you're required to take out minimum distributions when you turn age 73. Could be age 75, depending on your year of birth, thanks to the Secure Act of 2022. But either way, when you start taking out the required minimum distribution, the government is forcing you now to sell your principal. Before, you wasn't selling it, but now you're going to be forced to. And so, again, it's the same problem. They're forcing you to take it out. and you're wanting to still preserve your money. Now, I've never met one person that likes to see their balances change. Ultimately, they want their portfolio to grow. They can deal with some stress, but they don't want to deal with a lot of stress. And so in order to minimize stress, you've got to invest for income. If you invest for income, you have less stress. If you want to know more about investing for income, I got a commission report I want to get in your hand called Passive Income for Retirement. It's instruments that people use, network people use, to be able to generate income and not sell their principal in retirement. As not selling your principal means you're going to have a better inflation hedge, because now all of your principal goes back in value. It goes down, it goes up, it goes sideways. It doesn't really matter. You're not selling shares. Share prices go back to the norm, and then hopefully they go up over time. That's what you're trying to do. But all you're doing is taking the income doesn't change scenario each and every year. And if you would like to have that commission report, call 888-930-1080. 888-930-1080. We'll mail it or email it, whichever you prefer. 888-930-1080. You're tuned in to the Retirement Income Source. This is Tim Sparks, and today we're talking about income does not change. Total return equals I plus G. I is there because it's separate as far as how you generate return in mutual funds, stocks, bonds, ETFs, whatever tools you use out there. There are some tools that don't generate any I. Speculative land. If you just buy land, it doesn't generate income. If you buy gold, it doesn't generate income. Silver, it doesn't generate income. Bitcoin, cryptocurrency, does not generate income. That's just strictly capital appreciation. You're hoping to make more by holding on to it in the long run. But there's other instruments that do pay income. There's stocks that pay income. There's stocks that don't pay income. There's mutual funds that pay little to no income. There's mutual funds that pay some income. It's all the same story. It doesn't matter which one of those tools you use. Well, you're in retirement, you want to biggie size your income side, the I side of the equation, if you want your money to last longer than you. Some people will ask me, well, how long will the income pay? Well, as long as you're living. If you die of natural causes, let's just say you die in your rocking chair like my grandmother did years ago, then that's what I call more natural causes. That nothing, you didn't go to the hospital, you didn't have to, take extra money out of your principal or whatever because you're fighting some disease or whatever, and your hospital was charging you all this money, and maybe your Medicare payments and your supplemental insurance is not helping you, so you got to pay something out of your pocket. Sometimes it works, sometimes it does not. We really don't know when it comes to the inconvenience of death and how it's going to actually force us to spend money into the future. But income doesn't change. This is swept under the rug a lot now, and a lot of times I think people just really don't think anything of what we're talking about. They think if their portfolio jumped up 20% last year, they call that income. No, you have to spend that. You got to sell that in order to get income from what you just now received. I didn't tell you what our total return was in our client's portfolio. I only told you the income side of the portfolio, the income that doesn't change. Your income doesn't change, my income doesn't change, or the income that doesn't change, and the what we specialize in income for our clients. And so $50,000 doesn't change on $1 million, neither does 10 to 20,000 doesn't change. I'd rather have 50 that doesn't change than 10 to 20. Well, most people, 99% of the people that are listening to the show, it's more like 10 to 20 is all they're getting. They could get 50, but they, for whatever reason, they don't want to take the time out to be able to learn, be intentional about how income works. At the end of the day, if you really knew what your portfolio was doing to generate income, you wouldn't walk, but you would run to get away from that. But that's the whole point of this show, is to be able to educate the public and inform the public of what's really going on when it comes to retirement income advice. Just because somebody says they're a retirement advisor doesn't mean that they're not helping you to slowly but surely see your principal dwindle. It will dwindle, and it's very hard to make it up because the impact of inflation forces you to take more and more out of your portfolio year by year. Last 3 years alone, inflation's up about 25% compared to just a few years ago. So inflation is a problem, and it forces you to take more out of your portfolio. If you would like to learn more about income first methods, then I got a great book on to get in your hand. It's written by your host, Tim Sparks, Amazon bestseller, #1 in 6 different categories of personal finance, #1 in Amazon, and I got a free copy for the first 5 callers of today's retirement income source. Call 888-930-1080, 888-930-1080. We'll mail this to you if you are one, and this again, a free no obligation book, 888-930-1080. You're listening to the Retirement Income Source. This is Tim Sparks. I'll be right back. Welcome to the Retirement Income Source. This is Tim Sparks. Our show is sponsored by Sparks Financial Group right here in the heart of the Bluegrass, Lexington, Kentucky. Also serving Louisville, Kentucky, Northern Kentucky, and Central Kentucky. Today we're talking about income does not change. I like to bring up the value of income in many different ways because, they always say we learn more by repetition. And I can give you many analogies to be able to hopefully, and to help you to understand what we mean by investing for income first. Well, if I'm getting 5% and I need to average 7%, which is what the S&P 500 is averaged in the last 25 years from the beginning of 2000 till now, I only need to earn 2% from growth if you think about it for a moment. 5 plus 2 equals 7, right? I only need 2. Well, I can do that by having a mixture of individual stocks that pay dividends that get me that 5%, and also other bond and bond-like instruments. Well, depending on the mixture of stocks that I have, I can reach that goal. Another thing too, I can be interchangeable with a portfolio. Why? Because I've got more leverage than what most financial advisors do. Why? Because I still have the principal intact. I can make changes on a whim faster. First of all, I'm a fiduciary. Everything's done more like from a wholesale perspective. We can't make commissions. So if you think about it for a moment, I can move things around and become a capitalist for our clients, which sometimes we do whenever we feel like, or the client does when we meet quarterly, that they need to make changes to the portfolio. They can do that and make an easier decision in the transition into that if we want to add some growth in years that we feel like that in the next coming years, I think the markets are going to be a little rocky here the first half of the year, and who knows what the second half of the year will be. But I do think that there's going to be some tax law changes that are going to benefit the stock market and so forth, but they may not. At the end of the day, we can't control what the markets will or won't do, because you can have the perfect scenario and still have a down market. And if you go back historically, back in the industrial age, we were climbing industrial, as a power in the world, but yet stock market didn't do very well for many, many years. In the agricultural age, the same way, or the trucking industry age, when the trucking industry came out, where they were starting to move goods from state to state and so forth. But again, there was patterns in the market. The markets didn't do well. You can have everything perfect and still not get what you want when you're in the market. You can't control that. But there is sectors, there's different types of sectors like healthcare and real estate and so forth that actually some years you want to have more exposure and other years you want to have less exposure, but you want to be in all sectors because nobody perfectly knows which sector is going to actually do the best. But to some degree, an analyst has a better chance of knowing that than me or the amateur or the majority of financial advisors. They're guessing. But analysts don't guess. What they're looking for is, especially if they're really good at their game and they just specialize in income, and they're getting all this income coming in, that's not a problem. It looks like that maybe like last year, communications was a really big sector due to the fact that, anytime you got a presidential election, both parties are going to spend a ton of money on, on the internet, social media, and also spending money on television. Why? Because they're trying to get they're trying to buy your vote, right, so to speak. Well, communications really did increase. There were several stocks out there that did extremely well. Well, believe it or not, for the clients that was interested in that conversation, I knew that was going to happen, but majority of people don't know that. A lot of people, they may catch a little sniff of that kind of return on those type of sectors, but they don't really get the benefit of it because nobody's really there to actually help them to know that exists. It doesn't mean that every client that we work with. Some clients they're more risk averse. They don't want to take they want to take more of a conservative route, maybe a more moderate route, and so that isn't for everybody. But I knew that going into it. Just like if interest rates come down, there's going to be 2 or 3 sectors of stocks that's going to do well. Well, you got to be privy to know what, you got to kind of be on the inside, not inside trading, something illegal. I'm talking about you got to be on the inside to be able to know what that is and what different economic environments can do to trigger either a good market condition or really maybe a worse market condition. And we have to deal with both, right? There's good, the bad, and the ugly when it comes to stock market. Yeah, we're told the markets always go up, but that's not always the case. And, since 2020 till now, we've had some times that I'm sure, and you probably just felt it here recently, that, is this the big one? It's kind of like Fred Sanford used to say on Sanford's Son, Elizabeth, I'm coming to meet you. We have those thoughts going on whenever the markets go down. Well, you got to keep in mind, retirement is not about fluctuating of the market. You can't control that. What you can control is the amount of income from those instruments that fluctuate. They may fluctuate on paper, but the income does not change. And I will keep on coming back to that. People don't understand the value of the income. Imagine the next 10 years. You have $1 million and you got $50,000 a year coming in that is not going to touch your principal whatsoever. 50,000 times 10 years is $500,000 and never touching your principal. Flip side of the coin, what 99% of the people that are listening to this show, if you took out the same 50,000 a year for 10 years, you're spending about 350 to 400 of your own principal. You got to regain that back because all you got in dividends was about 10 to 15,000 a year if you hired an advisor, a middleman, which charges a fee on that portfolio. We're talking about net to net here. I don't know about you. I'd rather have the 50 and not touch my principal than 10 or 15 and not touch my principal, and then 10 or 15 and have to spend my principal and spend 2/3 of it each and every month. It's not a good recipe no matter how you look at it. I know other people, they'll put money in their money market. Money markets right now are paying 3.5% or 4.25%, whatever they are. Enjoy them while the rates are up. But what are you going to do when the rates come down? And not only that, the rate of the yield that you're going to earn in the money market depends on how much you put in the money market. So if you got $1 million and you say, I think I'm going to set aside, maybe 150 or 200,000, that's equivalent to 3 or 4 years of income. Well, that 200,000 is earning you 3 or 4%. What about the other money? This is still, again, based on growth. And not only that, you had to raise the cash, which means you had to sell from the $1 million portfolio. And happy hunting, you might have been, you don't even know. I know people that probably don't know what they're doing. They'll just sell shares and assuming, that this plan is going to work. And so they put it in that reserve tank over here, and they're not realizing that, anytime we can have another 2013 where there's no returns at all, and that philosophy won't work. It doesn't matter how you slice and dice it, it will not work. So if you want to learn more about income first methods, then I would encourage you to reach out to our 800 number, 888-930-1080. Again, that's 888-930-1080. And I'll send you a commission report detailing the type of instruments that can generate that income and not touch your principal. It's really up to you. At the end of the day, it's your money. Whether you're either going to spend principal or you're not going to spend principal in retirement. And this commission report will help you to understand what instruments out there that actually generate income first. And so you can get that. We can mail it or email it, whichever you prefer. 888-930-1080. This is Tim Sparks, and today we're talking about income does not change when markets either go down, they go sideways, or they go up. If they continue to go down more, which we've seen that kind of back and forth, tipsy-turvy, in the last few weeks, you don't know. You have no control over what they're going to do on a day-by-day basis. If we go into a recession, you couldn't control it. What you could have controlled is how you invest your money to generate income even in a down market. Our clients, I know in the next 12 months, even if the markets drop 30%, what you're in, the instruments you're in, they drop 30%, you're not going to spend income, but the clients that we work with will still get that income. Why? Because they're based on income first methods. They're using contractual instruments. Contractual instruments, yes, they can see about volatility, but lesser volatility than what you will see because your portfolio is not designed for income first, or it's more designed for growth, and growth has more volatility. So if you want to be in an environment where investing for income is your friend, not your foe. And if you want to know more about whether you're getting the income you need and you deserve, and give yourself a pay raise, kind of like going to Wendy's, they say, do you want to biggie size that French fry? Do you want to biggie size your income? Then we got a retirement risk report that we actually cover by phone. You can schedule that appointment. That will be done by the phone first, but even determine whether you are actually already doing that now, which I would say most people that we talk to do not. You probably want to call 888-930-1080. We'll do what we call a retirement risk review. The retirement risk review is a single one-page proprietary report we utilize. No report that I've seen out there makes it that more simply than to know the difference between part-time income and full income. In other words, what you're leaving on the table by investing still in the market. I'm not taking you out of the market and put you in some kind of a wonky other instrument, but how to get real income, how to determine whether you're a good candidate for a Roth IRA conversion or not. Also, there's the things like fees. How many extra fees are you paying in addition to the money management fee that you're being charged by the advisor? And everybody gets paid. We all know that, right? So at the end of the day, I get paid, everybody gets paid. At the end of the day, it all matters of what are you getting in return for the amount of money that you're actually being charged. And we cover many, many different facets in that report. And also, more importantly, how much risk. There's a way to stress test your portfolio to find out, are you in a position philosophically and emotionally to handle, another 40% loss. Most of you probably don't even know that you could lose 40% of your money in another down financial crisis like we had in 2008 or some other crisis. I mean, we can call financial crisis. You go back in time, there was all these different crises and we give them all new names. Oil embargoes, et cetera, right? We all know that dot-com bubble, inflation crisis that we had in the 66, 1982, the Great Depression. I mean, all crises are different. So the next one, we don't know where it's going to happen, how it's going to happen, and what new name we're going to give it, but we're going to have a crisis, and you have to prepare for it, both emotionally and philosophically. Invest for income is the best way I know how to be able to get through something like that, because there's a lesser risk with income coming in, especially if it equates to the income you need, versus taking money from principal, which means if you don't even know you're taking money from principal, you can actually be spending principal faster. Selling shares is what that means, because those share prices are worth less. They were worth more, now they're worth less. Imagine selling your house in 2008. Most of you probably are listening to this show would have never sold your house in 2008, because values dropped in real estate. Well, it's the same scenario when you're selling mutual funds. You got stocks in them and they're down, cut in half. That means you're going to sell twice as many shares. You got to keep in mind your portfolio is designed for income. If your real estate value, that's a choice. You don't have to sell, but you do have to get income. So that's a little bit more, the makeup of your portfolio is going to make a difference of what kind of retirement you're going to have, either a stress-free one or a stressful retirement. That's the reason why I would like to get a book in your hand, a free, no obligation book. It shows you how to get an extra 5%. That's what our clients are getting right now in a custom portfolio built for income first. And the name of the book, Retirement Income Shift, How to Get the Most Mileage Out of Your Money. Number 1 on Amazon for basically 3 months, 6 categories, personal finance. I got a free copy for the first 5 callers of today's retirement income source, 888-930-1080. Again, that's 888-930-1080. And we'll mail this to you if you're one of the first 5 callers, free no obligation book, 888-930-1080. You're tuned in to the Retirement Income Source. This is Tim Sparks. We'll be right back. Welcome to the Retirement Income Source. This is Tim Sparks. Our show is sponsored by Sparks Financial Group right here in the heart of the Bluegrass, Lexington, Kentucky, serving Louisville, Northern Kentucky, and Central Kentucky markets. Today we're talking about income does not change. I mean, if you think about it for a moment, income is always the problem. By the time you turn 18, 19, you start getting into the workforce, you go to college, whatever you do before you go to work, all the way to the time you check out, you're always going to need income. And if you go back 30 or 40 years, income was probably less, and even you didn't need as much as you do today. Why? Because inflation puts an impact on how much you need, because all the goods and services, utility bills, insurance, premiums, whatever, continues to increase. Well, if that's the case, then investing for income and getting the most mileage out of your money is really the only option I can think of. Now, the only way you're going to know that is to be intentional. Get the information we offer you on here on the show, and at the end of the day, you can determine whether you think income makes the most sense. All I know is heads you wins, tails you lose. That's what retirement's all about. If the markets are going to go up the next 20 or 30 years, even though you can't will the markets to go up, but if they go up, by accident, you retired comfortably. And that was only by accident. Why? Because the markets cooperated in your favor while you're in retirement. But what if it's the other flip side of the coin? Well, the reason I say that, because typically in a 30-year time frame, we look back historically, we've always had recessions and recovery recessions. Not what you read online, they'll tell you it takes 3 to 4 years to recover from a recession. It's because a recessionary period generates zero growth anywhere between 13 years on the low side, and that's what happened in the early 2000s, all as high as 25 years in length. I mean, think about it for a moment. There has been 4 different times historically, and if I was to do the math, about 125 years, ever since 1899 or 1900 to now, over half the time the markets were no growth at all. And so you got to understand, that's the reason I can easily say 50 heads you win, tails you lose. I mean, it's a 50-50 chance. And so if you're basing everything on growth, then you're running the risk regardless. And not only that, if you had income and that still doesn't cooperate, the good news is you still have your money. That's the difference. I'd rather have my money and plan for it and not have my money and didn't plan for it. It's somebody once said, if you get on the wrong train, be sure you get off at the first stop. The longer you stay on, the more expensive the return trip is going to cost you. Well, it's the same way when people go into retirement. The first 10 years may seem to be the pretty easy when you step into retirement. It's the next 10 or 12 years or 15 years of your life that's going to make a difference whether it was successful or not. And what I call successful, now you may call successful you may be one of those, that just maybe, hopefully you don't stick your head in the sand and it doesn't really matter to you. I don't think that at all. But sometimes we really don't take the time out to really understand how money works. Income keeps money in motion. Non-income instruments, what most people are investing in today, or very little income, is not going to do much, even from a dollar cost averaging standpoint, if you don't even need income. I've had people come in and say, well, I really don't need income. I said, okay, well, let's design your portfolio around, let's see what your risk comfort is first. And a lot of times people will tell me moderate. I said, well, I hate to tell you this, but moderate basically means 20, 30, or 40% in stocks, maybe 50, depending on what advisor you talk to. Well, what you're saying is you're okay with half your money making money and the other half your money just kind of staying there in limbo and making a little bit of yield. And that's all bond funds and cash does. They're yielding instruments. They're not made for growth. If you're a growth person, then you want to have all stocks paying you dividends. You can even mix it in with some growth. I prefer dividends. Why? Because dividends, I got more money. I got more usage out of my money. I'm going to get more mileage. And not only that, I'm going to dollar cost average and buy more shares, even while I'm in retirement. The same it was before you stepped into retirement. You accumulate assets by dollar cost averaging, which is contributions to your retirement plans. So there are instruments out there, if you want to pay raise, if you want to be conservative, or if you don't need income, what are ways still to be able to appeal to a return every year and keep your money in motion and getting the most mileage out of your money? Well, there's a great report out there called Introduction to Income Generating Strategies that you can learn and utilize what our clients do today. And it's really not rocket science. And so if you would like to have a commission report on that, call 888-930-1080. Again, that's 888-930-1080. We will mail it or email it, whichever you prefer. 888-930-1080. So I want to end here as we're getting toward the end about dollar cost averaging and investing for income, not needing income in retirement, and the value of that. I explained this a lot a couple months, maybe a month ago, because remember the name of the show, Income Doesn't Change. Well, income doesn't change. I should have said income continues to increase for those people that don't need income. Because think about it for a moment. If you got $1 million and you're generating, you got all dividend stocks and you're generating, $35,000 to $40,000 a year in dividends. At $35,000, $40,000 in dividends, or $40,000 in dividends, let's just say 40 to keep it a simple number, is going to increase in 12 months. Why? Because those dividends get reinvested quarterly, so it's quarterly compounding, and it reinvests and it buys more shares. It buys more shares and increases your income. Every time you increase shares, you increase your income. And so the following year, your portfolio may still be worth $1 million. It may be up to 1.2. Nobody knows what the growth component's going to do. But at the end of the day, your income jumps up from $40,000 to $42,000. And it does this every year. In 10 years, your incomes may have started today at 40, but maybe at 50, 52,000 a year. Why? Because dividends keep increasing in the portfolio. That works, especially where we like using that for people that are preparing for retirement and they need income for retirement. We say, why not reduce your risk now? If you got a 401k and you can do an in-service rollover and you're going to be retiring in about 5 years, this is a great way to increase your income and growth at the same time. And matter of fact, you can actually somewhat put it on steroids because right now you're not getting it in your mutual funds and your 401ks. So I just wanted to share that strategy with you because I had a client that actually didn't need income. But in 7 years, they're going to need to start taking income called RMDs, required minimum distributions. So they had $2 million, a little less than $2 million. Let's just use a rounded number. And they still like the idea of generating growth. They were pretty much in growth already when they came in. So we did an analysis, and right now they're getting about 0.5% on their portfolio. This is a commission-based portfolio, so Commission means the money was paid up front, the way it's generated, but they're getting 0.5%. On $2 million, that's about $10,000. Well, unfortunately, they could get 35 or 40,000 reinvested. Well, that 35 to 40,000, which by the way is similar or close to what the dividend is going to be if they need to take it now, they don't need to take it now. But if you multiply that by 7 years, that's another 200 plus thousand that's reinvested back into stocks that hopefully go up in value, right? The word hope, because nobody knows. I'm not going to sit here and try to flatter you thinking what I think the market's going to do. Nobody knows. I want to think they're going to go up, but that's not necessarily always true. You got to embrace yourself in case they do not go up and they actually go the other direction. Because there is times and patterns historically that the markets have generated zero returns. After all, you're trying to win the game of what? Reducing your risk and increasing your return. We all want it. Well, if you would like to know more about income first methods, or I got a great book I want to get in your hand, my book, The Retirement Income Shift, Retirement Income Shift, How to Get the Most Mileage Out of Your Money. Amazon bestseller, 6 categories on personal finance, #1, according to Amazon, for 3 months since October. If you would like to get a free copy of that, call today, 888-930-1080. Again, that's 888-930-1080. And we'll mail this to you if you're one of the first 5 callers. Free, no obligation book, 888-930-1080. We hope you've learned a lot today from this show. Again, income doesn't change. You're to try it. You're to find out what it's all about. It can make a difference in stock market environment. Keep in mind, the stocks don't always go up, but the income doesn't change. That's the whole point of this show. We hope you enjoy the show. We look forward to next week for some more great information. Thank you for listening.